This is Ashwin with over 14 years of experience in insurance, reinsurance, and catastrophe modeling analytics. In the topic of discussion today, we will discuss catastrophe bonds, also known as CAT bonds. In the PPT, we will discuss the traditional and alternative reinsurance capital available in the market and also CAT bond market size, evolution of CAT bond, its participants, and the type of triggers. Over the end, we will discuss CAT bond structure with an example and its advantages. So let's get the PPT started. As of mid 2024, the overall reinsurance capital available in the market is about USD 695 billion, out of which capital from traditional reinsurers is 585 billion and alternative capital constitutes to about 110 billion. The investors in alternative capital are leading hedge funds, pension funds, and mutual funds. Within the alternative capital of 110 billion, we can notice that cat bonds is about 40 billion, sidecars and industry loss warrants combined is about 18 billion, and collateral reinsurance is about 50 billion. So as of 2024, the market size of cat bonds is about 40 billion. Of catastrophe bond. Cat bonds were born during one of the difficult phases for property and casualty insurance industry. In 1992, Hurricane Andrew made landfall in the US, causing failure of 8 insurance companies and pushed others to the brink of insolvency. Homeowner prices in coastal communities rose significantly for insurance, and this led many large insurers and reinsurers to reduce exposures in coastal areas. Additionally, publicly funded state insurance programs such as California Earthquake Authority, Texas Windstorm Insurance Authority, and Florida Hurricane Catastrophe Fund were created. New capital had to flow due to the demand for natural disaster related insurance. To increase available capital, insurance industry created a new financial instrument called catastrophe bond, which are income instruments issued by insurers and reinsurers to transfer exposures from potentially large insured losses associated with NatCat, as well as other perils such as terrorism and cyber risk, to the investors. The first cat bonds were created in 1997, giving investors the opportunity to earn an attractive return on investment uncorrelated with the return of other financial instruments. Catastrophe bond. Issuers, structuring agents, modeling agents, rating agencies, and investors are the participants. Issuers are typically insurers and reinsurers but can also be government agencies. Structural agents assist the issuer in selecting the trigger type, which we will discuss in the upcoming slides, and level of protection, that is attachment and exhaustion points. They also assist in placing the bond with investors. Structuring agents are basically investment banks or capital market arm of leading broker or insurer. Swiss Re Capital Markets, Goldman Sachs, and Aon Securities are example of structuring agents. Modeling agents estimate the risk of the bond. They also model in case of modeled or industry loss trigger. There are three modeling agents which are Moody's, RMS, AAR, and Equicat. With respect to rating agencies, both Standard and Poor's and AM Best rate the cat bonds. Investors, investors such as hedge funds, pension funds are the investors in a cat bond. Is an example of participants in a catastrophe bond. American Family Insurance is the cedent or the sponsor. Maria Re is the special purpose vehicle or also known as SPV, which issues the cat bond on behalf of American Family. Aon is the structuring agent which helps the sponsor in selecting the size and trigger type. AR Worldwide is the modeling agent. There is no rating present for this bond, and investors are leading hedge funds, pension funds, and the mutual funds. With respect to issued cat bond, the peril region covered is US severe convective storm. Size is about 100 million USD. Trigger type is industry lost index, and date of issue is December 20. Four types of cat bond triggers, namely indemnity, industry loss, parametric, and model trigger. Indemnity, it's a cat bond that pays out based on actual insurance losses experienced by the issuer. Industry loss, it pays out on aggregate losses to the industry and employs third party modeler to provide estimate of the covered losses. Parametric, it pays out based on measured strength of the catastrophe, such as magnitude of an earthquake, wind speed of a hurricane. What is model trigger? It is based on claims estimated by a computer model. As can be seen, 70% is from indemnity and 20% are from industry loss index. Why 70% of the cat bonds are based on indemnity trigger? That is because it eliminates basis risk, which is the difference between sponsors losses and bond payout. So let's say, for example, if actual losses are about 60 million and bond payout is only 45 million, it means that 15 million is the basis risk. So lesser the better. So that will be the most of it will be less for indemnity cat bond triggers. Let's discuss indemnity first, as they constitute to about 70% of the cat bond triggers. As they are based on actual losses, indemnity, as they are based on actual losses, settlement time is highest for indemnity triggers. Regulatory acceptance is high too for indemnity triggers. Basis risk is the lowest. Transparency too is the lowest, as it is based on insurers' actual losses. Parametric. Parametric is the most transparent, as it is based on strength of a catastrophe, but basis risk will be maximum, and hence there is no regulatory acceptance. Nowadays, model loss trigger is almost extinct. It is not being used to a larger extent, and industry loss trigger ranks in the middle in terms of transparency and regulatory acceptance. What is the structure of a cat bond? Seeding insurer or reinsurer sponsors a cat bond. Special purpose vehicle or SPV is an entity created as an intermediary between the issuer and the investors. SPVs are basically created in offshore destinations like Cayman Islands and Bermuda. The issuer pays annual coupon payments as premium to the SPV. SPV then transfers the premium to the investors. Investors purchase the bond and sends the cash proceeds to the SPV. SPV then creates collateral account and invests cash in US Treasury money market fund. The return from US TMMF is passed on to the investors. So investors get cat bond coupons paid by the issuer, and then return on collateral, that is the cash invested in US Treasury money market fund as returns. If there is no losses to the cat bond over the term, the cash in collateral account is liquidated and investors get the full principal amount. If there is a loss, issuers are provided with the loss payments. Let's look at structure of a catastrophe bond with an example. So in our example, American Family Insurance is the sponsor or the issuer. SPV is named as Maria Re Series 2010-2, wherein 2010 denotes the year of the catastrophe bond, and 2 is the second issuance. And we have the investors who invest in the cat bond. Re acts as intermediary between American Family and the investors. 6.5% annual coupon payment is paid as premium to the SPV, and the premium is sent to the investors. Cat bond size of 100 million is purchased by investors and cash is sent to the SPV. SPV then creates collateral fund and invests in US Treasury money market fund. Returns from US Treasury money market fund are passed on to the investors. Industry losses occurred to the tune of 21 billion, and the attachment point of 825 million was breached. Hence, American Family received the loss payments, while the investors lost the principal amount, which is 100 million, but they received 6.5% annual coupon payment premium and then the returns from the US Treasury money market fund. Let's look at advantages of a catastrophe bond for issuers. Unlike traditional reinsurance, where it is possible for the reinsurer to fail to pay out, cat bonds are 100% collateralized and eliminate counterparty risks. Cat bonds provide possibility of multi-year commitments, whereas most reinsurance deals that are traditional are for 1 year term only. By attracting alternative sources of capital to compete with traditional reinsurance, cat bonds pull down the reinsurance rates while increasing the total capital available in the market. For investors, cat bonds are largely uncorrelated with returns of other financial market instruments. This is largely seen as major advantage of cat bonds. And cat bonds have provided strong returns, helping to attract alternative sources of capital into insurance markets. So this marks end of the presentation. Thanks a lot for your time, and I await your feedback.